Hey Bowtie Nation, Joseph Hogue here with a new list of penny stocks, something we haven't talked about on the channel in quite a while. There is a reason for that. Rising interest rates and an uncertain economy have crushed a lot of penny stocks over the last few years, making it hard for even the best companies to grow. That is changing right now, and in fact, there are 3 catalysts coming up that could make this year very good for these stocks. I'll reveal those catalysts, along with 5 stocks under $5 each that you need to be watching right now. Let's jump right into that penny stock list with Rocket Lab USA, ticker RKLB, a $2 billion end-to-end space company with services in design, launch, flight software, and satellite components. A failed launch in September drove a 30% crash in the shares, but an investigation is wrapping up, and it looks like the company is back on track. Rocket Lab has a strong schedule of 22 launches planned this year, double last year's manifest, and that $582 million backlog in the third quarter was 9% increase from the previous. Management expects more than half that, 57% of that backlog, to be recognized this year, which is going to be more than $330 million in revenue. Revenue is expected up 75% this year to $435 million. Even more than that top line growth. What has me more optimistic on the shares is the progress in profitability. Even against that surge in sales, the company has been able to lower its operating costs, shrinking both R&D and costs for selling, general, and administrative. This is going to help drive those earnings along with an improvement in gross margin, which is up to 29% last quarter from just 15% the year before. So it's more than a little surprising that even though it looks like the company has rebounded from that September problem, the stock has not. Now, being a new company in that high-tech growth phase, cash flow is a tragedy here, burning through $135 million in free cash flow over the last year, but the balance sheet is healthy with $288 million in cash against just $61 million in long-term debt, so there are no liquidity issues here. With the improving profitability and booming revenue, the company could reach profitability next year and is going to continue to grow from there. We're just getting started on our penny stock list, but I also want you to understand why right now is a perfect time to be buying into these small penny stock companies. This is the kind of big picture environment that is going to help drive these stocks for years to come. And first is with the Fed cutting interest rates later this year, we're going to see borrowing costs fall, a huge catalyst for these newer, smaller companies. If you're Apple with a $2.9 trillion market cap generating $106 billion in free cash flows a year, it really doesn't matter where interest rates are because you're going to get any rate you want. But for a tiny $2.2 billion Rocket Lab, still posting negative cash flows and funding that business by growing its debt, lower interest rates are critical. That second catalyst for penny stocks. Most economists expect the U.S. economy to slow this year. The Conference Board is expecting sub 2% growth, and we see here in a forecast for major nations by Goldman Sachs at 2.1% for the U.S. in 2024. Now, that weakened economy could cause some pain among smaller companies, but it's going to be an opportunity to grab those bargains as they appear. If the economy does slow down, we could see the proverbial blood in the streets that makes for the best time to buy stocks. And the third catalyst, before getting back to that list of penny stocks, the rising stock market could fuel acquisitions of these companies. This was key when I worked as a venture capital analyst, investing before those acquisition waves that became exits for our startup investments. Booming stock prices means companies can get all the equity or debt funding they want to buy up smaller growth engines like the ones we're talking about today. Nation, it has become next to impossible to find an AI stock that isn't ridiculously expensive, but there could be an opportunity here in SoundHound AI, ticker SOUN, a $577 million provider of conversational AI to businesses that can be used to build AI assistants in more than 25 languages. And of course, the market for AI assistants could be ginormous, even larger than the $160 billion enterprise market SoundHound estimates. I mean, this is Tony Stark's Jarvis in the making, which goes well beyond that business use. And SoundHound's competitive advantage could be in its ability to reach a deeper meaning faster in its program. The AI combines the automatic speech recognition, or ASR, and the natural language understanding NLU steps in typical voice AI software into one step to understand that context and conversations in real time. That technology is backed up with a patent library of over 260 patents through speech recognition, natural language processing, and machine learning. Like many of these small growth companies, I don't want you to get too excited and going all in on one company or thinking it's a sure thing. SoundHound revenue is expected up 50% to $46 million this year, but is still deep in the red with $75 million cash burn. Its $96 million in balance sheet cash just barely covers $87 million in debt, so there will almost definitely be a funding round this year, maybe an equity issue on top of more debt. That could hit the shares when it's announced, but I think the potential means that you start building a position now and take advantage of any dips if they come along. The company had over $340 million in booking backlog as of the Q3 of last year, 10 times its revenue for the year. So against the risk of the small company competing in a very big market, this is a risk worth taking. We'll get back to those penny stocks to buy, but if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can now by joining me on the Blossom social investing app. It's like Twitter, Wall Street Bets, and the Wall Street Journal had a baby. The app was created by YouTuber Brandon Beavis for investors by investors. I just started using it last year and love it for getting ideas and sharing my portfolio. And this is so much more than just another social media app. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 90,000 investors in the social feed to see what everyone is talking about. I've shared my portfolio in the app and it's totally free to download, so look for that link I'll leave in the description below and check it out. Another sub $2 stock here with Tuya Inc., ticker TUYA, at a $975 million market cap. And I struggled with adding a Chinese company here because I know so many of you out there don't trust Chinese stocks, and there are plenty of others to go with, but I think this company is very well positioned in a strong growth theme of cloud and Internet of Things technology that really deserves a look. Tuya provides an Internet of Things platform as a service in the cloud with over 76,000 global customers. It's the largest IoT cloud platform with a unique advantage in its developer-first model to really drive those use cases for its enterprise clients. The company returned to year-over-year revenue growth in Q3 with 36% growth after being held back by the global chip shortage and supply chain problems in the last 2 years. It's now coming into some very easy comparables on those quarterly numbers though, and could continue to surprise. Revenue growth is expected to continue, and unlike a lot of these newer companies on the list, this one is already profitable. Tuya broke into free cash flow positive last year and a non-GAAP net profit of $10 million for the third quarter, a $26 million swing from the year before. On this growth, it's only trading at about 4 times on a price to sales basis, so quite a bit cheaper than the pricing you see in a lot of these other cloud stocks. Nation, these penny stocks will make you rich, but not in the way most investors use them. Most investors think penny stocks are only for trading, jumping in and out quickly for that 20 or 30% return. This is where you're taking advantage of those short-term trends or looking for a quick pop on a news release, technical signals, or a valuation change. And there is nothing wrong with that, and it can make money, but it's not going to be that kind of 10x returns I want to see. For me, investing in penny stocks is much more about that long-term view or getting in on those good companies before they become the industry leaders. Here you're looking for that competitive advantage in a product and a large market for sales growth. Now contrast that in that short-term penny stock trading. You're looking for a quick return and not necessarily a company that you think can change the industry. Here you're watching for stock prices that maybe break above their 50-day moving average, move into oversold conditions with valuations below their historical averages, or ones that might benefit from recent news or trends. In that longer-term investing strategy though, you're looking for a company with an innovative product that is changing the industry in which it plays. The company is growing sales at 20% or more a year for consecutive years and has a long runway for that larger market. You're looking for companies that are not only growing sales, but also improving on their costs, so making more money and becoming more profitable to build towards that positive earnings. And again, this type of long-term investing in penny stock companies is where I like to play and where you get the most bang for your buck. It's where I spent my time as a venture capital analyst, and it's actually less work than that trading strategy. That's because with penny stock trading, you have to constantly be watching your charts and finding those new targets, jumping in and out of stocks. With that longer term view, you're just investing in a handful of really great companies, holding on for those 5 and 10x returns. So again, you can make money trading penny stocks, buying in and selling after a 20 or 30% return. The problem is a lot of investors ending up selling their winners and holding on for dear life to their losers. They might get a 40% return on one stock, but then they hold on to a couple others, and it's just dead money for years until they finally realize that 30 or 40% loss. And so what ends up happening is your portfolio return. So that group of 10 or 20 penny stocks only ends up producing a 10 or 15% return at best. Instead, I want you to think of your penny stocks like a venture capital investor. You're buying into this company and you're going to hold it for that 5 or 10x investment return. Now, this is going to mean holding on to your penny stocks for at least 3 to 5 years, giving these small startup companies the time to grow and either be acquired or multiply sales by multiples higher. And yes, some of your penny stocks will be dogs. In fact, expect 4 out of 10 to be complete losers, but it's the rest, those 3 to 5 stocks that's going 10 and 20 times your investment that are going to make your entire portfolio a 20 or 30% average return. That's the venture capital way. Now, this next stock under $5 is a break from those high-growth tech themes with WW International, the old Weight Watchers. I recommended this one back in mid-2022 with the shares under $6 each on a strong brand and good cash flows. The stock surged when the company announced last year it would acquire Sequence, a prescription drug weight loss program integrating those GLP-1 weight loss drugs into its own program. The stock made it up as high as $13 a share before the market started to worry if that would be enough to turn the company around, and the shares plunged further in December when Eli Lilly announced its direct-to-consumer delivery on its own weight loss drug. Shares are back down now below $5 each, and we're rolling up on earnings that I think could surprise on the upside. The stock is back in value territory, and tracking app downloads through SensorTrack, Morgan Stanley believes downloads were up 19% in the Christmas through New Year's period and estimates new subscribers could be up as much as 300,000 in the fourth quarter. That weight loss drug segment is large enough. I think WW does well even with the competition and could get a bump on any good news. Now, beyond that investing strategy, another important point here about penny stocks is don't think that these are just stocks under $1 or even stocks under $5 like we're highlighting in this video. After every penny stock video, I get comments on share prices of the stocks, like, why am I talking about penny stocks with stocks at $5 or $10 a share? In reality, folks, there is no set definition for penny stocks. The most commonly accepted is a company with a market cap, a total value of shares under $1 billion. That's it. Stock price really has nothing to do with this. As an example, let's compare two stocks here. Alico Inc., ticker ALCO, is a $221 million company with just $40 million in annual sales, so a very small company here. Yet its shares trade for over $30 each. Now compare that with $41 billion Ambev, ticker ABEV, the multinational beer giant, with shares trading under $3 a share. Now, you certainly wouldn't consider Ambev a penny stock company. It doesn't have the fast growth or the flexibility we're talking about when we talk about penny stocks. The fact that its share price is under $3 each is just the fact that it's issued 15.8 billion shares, while Alico, with its solid growth, has just 7.6 million shares issued. So just always keep this in mind when you're looking for penny stocks. Price really means nothing. What you're looking for is these small companies with faster sales and earnings growth, companies with the flexibility to beat those larger competitors to the trends. Now revisiting a penny stock I covered back in 2020, Tellurian Inc., ticker TELL, is the lowest price on its list at under $1 a share. Tellurian is developing a portfolio of natural gas production, marketing, and trading, along with infrastructure that includes an LNG export facility and pipelines. The company estimates 156 million tons per year deficit in natural gas through 2035, and is building the business to be there when prices rise. So if you're bullish on natural gas, this is the pure play way to invest. It can take 5+ years to build an LNG terminal and get all those export license approvals, so the company has visibility on export growth, and it's just not enough. Now, of course, with the high capital expenditures to make this happen means even with about $200 million in revenue, the company is deep in debt and burning through cash. TEL owes over $500 million in long-term debt against just $60 million in cash reserves and is burning through about $200 million a year in cash flow. In fact, it chose to recently change its strategies, seeking to sell its upstream Haynesville production assets to raise money to complete the infrastructure projects instead of issuing more equity. The demand for natural gas and these assets is there. It's just a long road to build out and monetize. At 60 cents a share, this is probably the riskiest stock in the list, but could be a 3 or 4x return over the next couple of years. See the stocks in my portfolio and join over 90,000 investors on the Blossom Investing app with the link below, or click on the video to the right for the AI stocks I'm buying right now. Stocks that could make you rich before AI takes your job. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.